We finished last class talking about the valuation of bonds and worked through the Excel application. So now we'll talk about the valuation of stocks. Remember, with bonds, we knew exactly what the cash flow was going to be because bonds have contractual cash flows. The contract itself tells us exactly what our cash flow is going to be. So forecasting is pretty simple. With stocks, not so much. Stocks don't have to pay a dividend. They don't have to do anything specifically. There's no contract. It's just, as a stockholder, if you own stock in a company, you're one of the owners in the company. And after they pay everyone else, after they pay their bondholders, they pay their employees, their vendors, whatever's left over, the company can pay to their stockholders or they can reinvest in the firm. And there's no rules on that. We're seeing firms right now this year with COVID-19, we're seeing firms cut their dividends 80%, even 100% because of concern and lack of liquidity. Firms like Carnival Cruise Lines and obviously airlines that might typically pay a dividend are not paying any cash out because they're scared to death. They've got an 80-90% drop in revenues. And so stocks is a little trickier. And so what we focus in on stocks is forecasting, take the cash flows that the company is paying today and we try to forecast it into the future, assuming some growth rate. So the discount rate for stocks, we already know this. We did that before. It was the KE when we did the capital asset pricing model and we did the weighted average cost of capital. You did that in Excel application 6 and 7. So there's nothing new here. We're going to use that same formula again. So the cash flows, we usually use dividends. Firms pay dividends. How long in the future do we go? We essentially assume companies are going to stay in business for all of eternity. That may seem a weird assumption to make, given that most companies do go under at some time or get bought out by another company. But the advantage of saying all of eternity is even if the firm only lasts 50, 60 years, most of the value of the firm is going to be the next 50 years. So if it goes insolvent in 200 years, that won't affect our valuation very much because of the present value function. When you discount cash flows, even if they're huge, cash flows 200 years out will probably get discounted to almost zero today. And I'll show you that when I do the math. So we're going to use this perpetual growth formula. I showed you that perpetual annuity. I showed you that when we were doing the bond case. Remember we said if we take the cash flow divided by the discount rate, that tells us the value of that cash flow. I did that with the bonds where if the coupon was $30 and I divided that by the discount rate, half of the discount rate since the cash flow is paid twice a year. That gave me the value of receiving that coupon every 6 months for all of eternity. So it's a really simple formula. So if you have a stock that's paying a dividend of $8 and your discount rate's 8%, then that stock should be worth $100. Very straightforward. This is known as the dividend discount model, also the Gordon growth model. I don't know who Gordon was. I should look that up. But the Gordon growth. I think I misspelled Gordon there, but the Gordon growth model. Why he got credit for this, I mean, it's a fairly straightforward part of finance, but somehow he came up with this. You notice here we don't have any growth at all, so we have to talk about that. So very few companies actually pay the same dividend for all of eternity. You hope as the company grows that its dividends will grow over time. So the nice thing about this formula is all we got to do is we take the cash flow we're getting today, divided by the discount rate minus the growth rate. I showed you that earlier in the class when we were doing that the Carroll file and showed you how we could make that assumption to get a pretty good estimate of how much money Carroll needed over her retirement. We just assumed that her investment rate would be her investment rate minus the inflation rate, and by using that as our discount rate, we're essentially incorporating inflation into our assumptions. So with the stock, if we expect the stock to pay an $8 dividend, or they pay an $8 dividend today, and our discount rate's 8%, we expect that dividend to grow at 3%, then we should be willing to pay $160 for that stock today. So where did the 3% discount rate come from? We'll talk about that in a second, but what I want to do now is just show you this in Excel. I would not try to copy me this in Excel. What I'm going to do is I'm going to use Walmart, and well, eventually you're going to want to follow me in Excel when I do the Excel application example. I'm going to do Allstate and show you how that works. So I'm going to do Walmart, just to give you an example. So Walmart pays a dividend right now of $2.16. You can get that off of Yahoo Finance. So here's Yahoo Finance. I have Walmart loaded, and you can see their dividend. It says the forward dividend. I would ignore that. This is an error that Yahoo Finance makes. This isn't the right dividend, $2.16. The right number is probably $2.14. What Yahoo Finance does is they take the last dividend that Walmart paid, the last quarterly dividend, they just multiply by 4. And that's not really the best way to do it, but we'll use this number. If you take my investment class, I show students how to actually adjust and get the more accurate number. But 216 is close enough. It's not going to be that far off. So we need a discount rate. So remember the capital asset pricing model, CAPM. It said that KE equals the risk-free rate. We usually use a 10-year treasury there, plus beta times the market or equity risk premium. Market and equity risk premium are the same thing. So let's say that the risk-free rate, let's just say it's 2%. I know the 10-year treasury is well below 1% right now, but just to keep things so we don't get really bizarre answers, we'll say 2%. And let's say the market risk premium is 6%. And for beta, you know, you talk about beta when you did Excel application 7. So beta for Walmart, this is a discount store, definitely below 1, definitely a defensive company. They've actually done very, very well. They did very well in 2008, and they've been doing very well here recently. I'm going to give them a 0.7. I won't go all the way down to say 0.5 like I would maybe for a grocery store, but 0.7 seems fine to me. So that gives me a discount rate. Remember with the WACC, we called it the KE. Okay, remember that formula? You take the risk-free rate plus beta times the market risk premium. So we get a discount rate of 6.2%. And let me give you a growth rate. Let's say I think Walmart's going to grow its earnings, say, let's try 4.5%. The economy should grow 4 to 6%. Walmart's pretty saturated in the U.S. They're still growing overseas, but it's not they've got some intense competition, whether it's Amazon or Alibaba, or even in some countries where there's a lot of population like India, there's a lot of retailers there that are extremely difficult to compete against. Walmart's trying to get into India, and they purchased a firm a couple of years ago called Flipkart, but it's just been tough. So it's hard to see Walmart's going to be a high growth company, but they'll be at the lower end of my growth rate, 4.5%. Now this is the part you shouldn't copy, but I'm going to take year 1, year 2. I'll just do this all the way down. I'll go out several thousand years. And so let's say, what is the first dividend? Well, this dividend here is known as dividend 0. So let's look at the dividends. And so the next year's dividend should be last year's dividend, dividend 0, times 1 plus the growth rate. And then the next year should be that previous year's dividends times 1 plus the growth rate. I'm going to lock that in. Again, I'm worried to use the function keys with the recording going on. So there's the dividend for the second year. And we can now copy that down because I locked it in. We can copy that down. And when we do that, I don't know if this will let me, it's going to be a really wide column. Let me not do that. When we do that, the very, very last dividend, the very last dividend I can't even show it to you. It's so huge. In 3,000 years, it's whatever that number is. That's a large dividend. However, because of inflation, everything else, that may not value much. You might only be able to buy a loaf of bread with that. So there's the dividends. And so we'll take the present value of the dividends. So to get the present value of the dividend, we'll take each dividend divided by, y'all remember this, 1 plus the discount rate, just like we did with the bonds. My discount rate is 6.2%. Let me lock that in. And just like we did with the bonds, we're going to raise that to time, which is 1. And so when I copy that down, that gives me the present value. If I go down to that, remember that last dividend that was 14 whatever gazillion? On a present value basis, it's 0. It rounds to 0. So even though it's a massive number, when you discount it for 3,000 years, it's almost nothing. So what is the value of Walmart? Well, it's the sum of those discounted cash flows. So I get 132.78. Well, here's the dividend discount model. The dividend discount model says you can do the same thing just by taking dividend 0 times 1 plus the growth rate divided by the discount rate minus the growth rate. That's that perpetual growth annuity I've been talking about. So if we do that, we take, all right, so the dividend is 216 times 1 plus the growth rate divided by the discount rate minus the growth rate. And guess what we get? We get the exact same amount. You can see how the perpetual growth formula gives you exactly the same thing if you added up all these cash flows. And isn't this a whole lot easier than having to do all those years over and over and over again? Obviously in Excel it's not too tough to do, but that's the dividend discount model. Now what's interesting with this is if we go out, let's go out 50 years. I'm going to then do a sum of everything after 50 years. If I do that, I get $59. So after 50 years, years 51 through 3,000, we still have $59 of the value. So we got a stock that's worth $132.78. Over 1/3 of that is forecast we're making out more than 50 years. I don't know if Walmart will be in business in 30 years. There's a chance Amazon will buy them, or Alibaba will buy them, or Apple, or Alphabet. Someone will buy them. Who knows what Walmart will be. Probably a better chance Walmart will be in business in 50 years than JCPenney or Sears or Kroger's. But still, who knows what will happen in 50 years. And as hard it is to forecast 50 years, this stock, over 1/3 of the value of this company, is after 50 years. It's years 51 through whatever. So these things are really, really sensitive to the valuations. Their actual market price, what they're trading for today, we can look at that. We can see they're currently trading for $131.94. They had a good day today. They're up 2%, but the market's up 2% as well. $131.94. So it looks like, based on my model, that looks like Walmart's well valued. They're not. We think they're worth a little bit more than what the current price is, but not much more. So it's pretty close. So this is one of the models that you'll have to do when we do Excel application. The very last one, I think it's 11. So when we do it, I'll show you, and we're going to do something extra for this called the data table to make it even more valuable to us. But so you've already done some, try to convince you with the bonds and with the stocks. This isn't new information. All the stuff you did in Excel applications 2 and 3, and then 6 and 7, and even number 5, all those times you got a discount rate and you're discounting cash flows. You see how in finance we just keep doing that over and over again. We have simplifying formulas that help. I showed you the simplifying formula for the bonds and how to value them. Here's the simplifying formula for a stock. We're going to use 3 models. So one of them is the dividend discount model, but we'll use a couple of other models as well. So that is how stocks are valued. Coming up with the dividend was fairly straightforward. We just looked that up. So whatever the dividend is today The discount rate, you did that in Excel application 6 and 7. In 6, you came up with the discount rate. I gave you all the assumptions. You had to figure out beta on your own. In 7, I showed you how to figure out beta. So that 0.7 I used for Walmart, I would have done exactly what you did in Excel application 7. So you're doing everything you need to do. The only thing we haven't talked about is this growth rate. How do you get this growth rate for a stock? So we talked about sustainable growth, but it's been a long time since we talked about it. Well, I don't think I talked about it that much. It was a quick part of the notes. But you can say the growth rate for our firm is this return on equity. Remember return on equity, net income divided by net worth of the firm. So the return on equity of the firm tells you how fast it's going to grow unless they pay out dividends. So essentially the growth for our firm should be, and we call this sustainable growth, should be, I'm going to say should equal their return on equity times 1 minus their payout ratio. That should be how fast a firm can grow over time. The payout ratio is their dividends per share divided by the divided by the earnings per share. So if they made $3 in earnings and they pay out $1.50, they're paying out half of their earnings. What the sustainable growth says, if you pay out money, you send money to your stockholders, you cannot grow as fast. So we have to reduce that growth rate to let you know that we know you're growing more slowly because of the payout ratio. Now, what if we did this for Walmart? We're not going to like the answers if we do it for Walmart. Walmart's ROE, hopefully you remember ROE from your paper 1. So if I look on statistics for Walmart and I look at return on equity, let's see, I always forget what they put it. Here it is, return on equity. They have 18.86%. 18.86, so 0.1886. And what is their payout ratio? So we can go get that. Their payout ratio is 40.85%. 0.4085. Notice how I take percents and always convert them into decimals. I highly recommend you do that. So that means sustainable growth. We're going to get a really high number. Sustainable growth is going to equal 0.1886 times 1 minus 0.4085. That's going to be a really high number. I'll put that back in my Excel model here. What do I get? So I get plus 0.1886 times 1 minus 0.485. I get 11%. So what happens if I change my growth rate from 4.5% to 11.16%? And you're going to see two wild things happen. This 132 and this 132 will no longer equal each other. So you notice this model gives me a negative number, and this model gives me a massive number. I can't even show it to you. It's so huge. And it's not a negative number. It's a positive number. So how can these two things be wrong? So this is important to remember. What you'll notice is if my discount rate is greater than my growth rate, so my dividends are growing faster than my discount rate, what you'll notice about the present value of each cash flow, if you go back to 4.5%, look at each discounted cash flow. They're getting smaller and smaller and smaller. Even though the cash flow is growing, since it's growing at a rate slower than 6.2%, discounting at 6.2%, each cash flow's present value gets smaller and smaller and smaller. That's not the case if my growth rate is greater than my discount rate. each present value gets larger and larger and larger. So how many years would we have to go out until we get the zero? Or you notice here that very last one is not zero. It's a massive, massive number. You can kind of see it there. I don't know what that number is. Can you see it? For whatever 680,400. I don't know how many zeros that is. Let's see, 3, 6, 9, 12, 15, 18, 21, 24. Yeah, I don't know what that number is. It's beyond our comprehension. So the answer here is the dividend discount model actually gives you the incorrect answer. If your growth rate's greater than your KE than your discount rate, you made a mistake. The value of the firm is not negative 48, 45. The value of the firm is infinity. It's just that the dividend discount model doesn't know how to handle that. Anytime you get a stock valuation where your growth rate is greater than your discount rate, you made a mistake. Either your discount rate's too low or your growth rate is too high. And so that's important, but that is the sustainable growth. Now, why does Walmart have such a high sustainable growth? You know, I forget what number I just used there. So if we go back 1116, why can't we use 1116? Well, Walmart's had some really great couple of years here. So I think, yeah, they're very profitable. They have a great ROE, but I don't think this is their long-term sustainable return on equity. I think recently it's just been really good times for them. And so we'll have to talk about how do we get a better number. So this might be a good growth rate to use for the next 2 or 3 or 4 years, but to use this for the next 1,000 years, no, not even Google can grow, or Alphabet can grow their business 10% for all of eternity. It's just no firm, because if you're growing at 11% and the economy's growing at 3, 4, 5%, in about 30, 40 years, your company will be the entire world economy. It's just hard. You just mathematically, and hopefully you remember in your statistics class, just the compounding of growth. If something's growing twice as fast as everything else, it eventually takes over everything else and takes over the entire world. If Alphabet grows that fast and takes over the whole world, they can only grow as fast as the entire world's growing. They can't grow any faster. So we'll talk about how to get growth rate, and I'll give you some help. And that on our next session, we'll start there and talk about how to get a better number. What you're going to find is we're going to assume most stocks over the long term, at some point, they'll just start growing in the same speed as the overall economy. For a short term, they might grow faster, but in the long term, all stocks would eventually grow the same speed as the overall economy. All right, so we'll get into that next session.